Well, good morning, everyone. Today is Monday, April 20th, and we are joined with Jamie Oyer from Cincinnati on their annuity portfolio. But before we get to there, always got to cover today's national days. Today is National Cheddar Cheese Fry Day. It is also National Lima Bean Respect Day. I personally have little respect for lima beans, but apparently it's in all how you make them. National Pineapple Upside Down Cake Day. So far we've got 3 national food days. So if you're stuck at home, not sure what to make yet again for the 25th day, well, now you got some ideas, assuming your cupboards have the right food supplies. It is also National Look-alike Day. And of course, it is 420. And if you have clients that like to enjoy, we have many carriers with now much more liberal marijuana underwriting guidelines. So if that question comes up, feel free to reach out to your RVP case manager. We are happy to help. With that, I'm going to hand it over to Jamie. Jamie, take it away, and we appreciate you being here.
Wonderful. Thank you, Brendan. And thank you very much for the opportunity to be with you this morning and help get the week started. What we're going to do over the next 10 minutes, just kind of give you an update of or an introduction to Cincinnati Life, our fixed annuity offerings, and kind of how they may complement some of the other offerings and partners that you work with out there. Before we do that, though, I wanted to just take a moment and talk a little bit about why fixed annuities in this environment. A question that comes up on a regular basis is, well, Jamie, the interest rate environment is so low. Why would I want to take a look at fixed annuities right now? I've been with Cincinnati Life for about a year. Prior to that, I spent the last 20 years as an annuity wholesaler with a couple of different companies. And it's probably not going to surprise anyone on this call that my largest year of annuity sales ever was in 2008. So we all remember what happened in 2008. Equity markets were going straight south, right? Whenever equity markets start to get volatile, there's always a flight to safety, not with all of an investor's and retirees' assets, but generally a lot of times with a portion of their assets, the assets they're looking to keep safe, there's that flight to safety. So, and I kind of look at it this way. I mean, we're all, in the risk management business, we are, providing risk mitigation tools for our customers, various insurance offerings. Nobody wants boat insurance until their boat's on fire. And if you think about people that are getting closer to retirement, like I said, not that they want to take all their money and put it in a fixed annuity, a portion of that, though, they're going to look for a safety net. So what I've been doing the last several years is really kind of looking at fixed annuities as an additional asset class. Because if you look at it this way, if someone comes to you with $100,000 they're looking to invest, and there's a portion of that they want to keep safe, it's like, well, Jamie, I've got 80,000 of it. You pick the equities, you pick the mutual funds, separately managed accounts. I've got $20,000 of it. I refuse to lose. Where are you going to go? And if you look at the traditional asset classes, you've got equities, you've got bonds, you've got cash. With equities, you have upside potential, but you've got downside risk. With bonds, you have rising interest rate risk. I know we keep saying that rates can't go any lower. What happens? They keep going lower, right? But I think we would all like to think that we're going to be in a rising interest rate environment. As rates rise, the value of those bond holdings is going to decrease. And then if you look at cash, you have no growth and you have interest rate risk. So income annuities, when I say fixed annuities, talk about traditional fixed annuities that we sell. We'll get into those in a moment. Multi-year guaranteed annuities, fixed indexed annuities, kind of putting them all in that same category or as an additional asset class. People are looking to keep their money safe, right? They want help with their taxes. They like the tax deferral. They want a competitive rate. They want liquidity features, and they want estate planning advantages. As you know, with annuities, you're going to avoid that probate process. So that's why I really kind of look at fixed annuities in general as a traditional asset class, as a fixed income alternative, as people are getting ready to retire. Our average customer is 63 years old, so it's generally people in about 7 to 10 years of retirement. Now let's talk a little bit about some of the challenges that retirees are not just facing today, they've been facing for some time, but some of the key components why, regardless of what's going on in the interest rate environment with annuities, why it may make sense to position them for a portion of your client's assets. What are some of the challenges that retirees are facing? There are 10,000 people a day turning age 65 in this country. 10 years from now, we're going to have 11,000 people a day turning age 70. Let's talk a little bit about Social Security. Now, I know, everybody's situation is unique. There is no cookie cutter approach, but a traditional retiree, they can expect for Social Security to cover about 35% of their needed expenses. Let's talk about traditional pensions. Traditional pensions are all but a thing of the past. Less than 22% of workers today have access to an employer-sponsored pension. And when I say that, I'm including government employees as well. So if you look at the private sector, that number is going to be significantly less. So annuities were designed for income, whether it's income now, income in a little while, income in the future. That's why they were designed 2,000 years ago in the Roman Empire, and that's why they're still going to be here. So I just kind of wanted to give you a little background there before we talk a little bit about just Cincinnati Life in general, and then our product offerings. So just a quick overview of Cincinnati Life for those of you who are not aware. We are headquartered in Cincinnati, hence the name. The company ratings are very strong. We're A+ from AM Best, Fitch, and Standard & Poor's. Have a Comdex rating of 89. We're recently upgraded. We pride ourselves on our relationship-driven customer service. Those of you who have worked with us in the past, I hope you've enjoyed it, and I think you will enjoy a strong relationship going forward. If you'd like to learn a little bit more about Cincinnati, you can look at our balance sheet. You can get onto cinfin.com. Just wanted to quickly give an overview there and spend most of the time talking about our products this morning. As I mentioned, we are in the traditional fixed annuity market. So we have two deferred annuities. We have a single premium deferred annuity. We have a flexible premium deferred annuity. And then we also have an immediate annuity. So I'm going to go ahead and kind of basically cover both the single premium and the flexible premium together in the interest of time, because the core chassis of them is basically similar, and some of the key unique features that we have are going to apply to both. So talking a little bit about our single premium, that is a 7-year surrender charge schedule. Our flexible premium product is a 9-year surrender charge schedule. When I get to the next slide, I'll talk a little bit about the interest rates and how we work that and what our methodology is. One of the unique features, certainly, of both of these deferred annuities is the fact that we have a return of premium feature. So what that means is, like I said, 7-year deferred sales charge with the single premium, 9-year with the flexible premium. We will only apply that surrender charge schedule to the event that it does not invade their principal. So you can look at it as an early withdrawal provision, a bailout provision. One of the biggest concerns people have when they buy annuities, and we certainly hope that they're going into a deferred annuity for the long haul because these are long-term savings vehicles, but if unforeseen things happen, knowing that they have that return of premium feature, what we're hearing from a lot of the agents and advisors who are having success with our product, they like knowing that that feature exists. Taking it a step further, one thing we do not have is we don't have a market value adjustment. So not only do we have that return of premium, no MVA, and you all know as well as I do, the way market value adjustment works, if someone cancels 2 years from now and the interest rate environment is higher, they're going to receive a negative MVA. We do not have an MVA. Looking at our flexible premium for a moment, one thing that Brandon and I talked about that is very unique about the way Cincinnati structures our flexible premium product is subsequent premiums do not incur their own surrender charge schedule. So we have that 9-year surrender charge schedule, which starts out at 9% in year 1, goes down 1% a year over 9 years. We're going to revert to that original schedule. So if someone wants to put in, you can put in as little as $25 a month. Most flexible premium annuities, each addition you put in there is going to receive its own surrender charge schedule. Ours does not. The other unique thing about that is we pay full commission, full compensation on all premiums up through year 10. Now, the compensation that we pay is 4%. So additions throughout year 10 are going to get that full 4%. After year 10, we'll still pay indefinitely for subsequent premiums, but it's going to be cut in half down to 2%. We also do not have, we're not tiered based on age. So we issue up through age 80. As long as you can get into the policy, that compensation is going to be the same. So when you look at the fair surrender charge schedule, the return of premium feature, the way the compensation is structured, it's something that I think is certainly unique and will be a nice complement, like I said, to many of the other partners that you're working with. As far as liquidity, you can take up to 10% free a year. We have a long-term care facility and terminal illness benefit rider. Basically what that says is if you're in a hospital for 30 consecutive days, a nursing home for 90 consecutive days, or if you're diagnosed with a terminal illness, you can access any and all of the funds free of charge. So I did mention this on the last page, but we issue up through age 80. And like I said, there's no commission tier based on age. As long as you can get in there, you're going to get that 4%. The surrender charge schedule, like we mentioned with the Flex, it's a 9-year CDSC. Lower premium minimums, $1,000 for the initial premium, $25 a month after that. It's for qualified and non. For the single premium, it is $5,000 minimum for qualified or non. And premiums greater than $1 million, we do accept them. They just require field representative notification. So we just ask that you let us know. Talking a little bit about our immediate annuity. We have a single premium immediate annuity. It's going to have your basic standard features. Again, we issue it up through age 80. The compensation is the same. It's 4%, just as with the deferred annuities. Minimum premium of $10,000. This one, the way it would work would be you could call into E4 for an illustration. They would call us, and we can provide that to them. Where I don't want to spend as much time with the immediate annuity because the majority of our business tends to go in the deferred annuities, but I will let you know an area where we tend to be more competitive, and that would be in joint life, joint survivor options between ages 70 and 80. As I mentioned, I'm Jamie Orr. I'm the field director, the annuity director with Cincinnati Life. I partner with our life field representatives, so we don't separate the life from annuities. We all work together. We're all the same team. We're all there for you. I put my contact information up here, my email as well as my cell phone. 513-335-7003. Feel free to contact me if I can be of service in any way, in addition to the service you're already receiving through your partners at E4. Your life field representative is going to be your first point of contact. I really work as an extension of their team, an additional resource for them and for you. And I'm happy to help, work with some case design ideas. I recognize that, Cincinnati is never going to, there's no one size fits all option. We're never going to be the right option in all cases. In cases where we're not the right option, I'm happy to be forthcoming with that. So with that, we're kind of getting close on time here. I just wanted to hit the highlights of our traditional fixed annuities, some of the spaces where we are unique and where we may complement some of the other offerings that you have. With that, Brendan, I will throw it back to you and see if we have any questions or if there's anything else that you think I should cover.
You want to talk about the rates, Jamie?
Sure.
And the renewal rate history?
Absolutely. Let me try and pull my, well, actually it's not going to be on there, so I'll just talk about it. Okay, the way the rates are structured, and Brendan, I appreciate you bringing that up because I didn't hit that. With the single premium, the way it works is our rate is 2.4% in year one. Our guaranteed minimum after, so we're not a multi-year guaranteed annuity. We're a traditional fixed annuity. We're going to give you that rate for year one of 2.4. After that, our worst case scenario, our guaranteed minimum is 1%. Now, the unique thing about Cincinnati, and one of the things that really attracted me to Cincinnati when they offered me this position, which the annuity director position was the new one that they created just last year, was our renewal rate history and our renewal rate integrity. So I want to be clear. I want to manage the expectations and let you know that, yes, the minimum, I can only guarantee you 1% after the first year, but the way that we have treated renewals in the past is generally we have treated new money the same as old. So I'll give you an example. If someone bought an annuity with us last year and the rate was 3.2%, if they were to renew right now, they would renew at 2.4 because that's what we're offering on new money, right? Conversely, in a rising interest rate environment, and that's one of the situations that people think about when they say, well, I don't want to tie my money up, right? If we're at 2.4 right now, if we're at 2.8 a year from now, I can only guarantee you that we can offer 1%, but 2.8 traditionally is what we would do. And we do actually publish that renewal rate history, and I'm happy to share it with any of you that are interested. So that's on the single premium. On the flex, flexible premium products, they're more expensive in the administrative costs, so the rates are a little lower. It's 2% in the first year, 1% in the guaranteed minimum. After that, renewal rate integrity is the same.
Jamie, one other question I have.
Sure.
I know you issue up to age 80. On the flexible premium, do you allow contributions past age 80, and at what point would you stop allowing contributions?
Wonderful question, Brendan. We will accept premiums after age 80, and We will pay compensation on those. It's the only time that we will not receive new premiums is once the policy has matured or annuitized. Now, the default age is 85. You have the ability to push that back in 10-year increments, so you can actually push it to age 100 before we would force annuitization. And at any time, it's still in the deferral phase. You can continue to add to it. So, thank you for that question, Brendan.
Perfect. That covers questions I have. We are at 15 minutes, but if anybody has questions, please unmute yourself and speak now. Otherwise, I want you all to have a great week and enjoy the nicer spring weather. Thank you all.
Thank you all very much for your time. Look forward to partnering with you.